Welcome back to Everything Financial Radio. I'm your host, Dennis Tubbergen, and we have the distinct pleasure of chatting today with Mr. Harry Dent. And Harry, I had a guest on the program, and I won't mention necessarily his name. The listeners may remember, but he is calling for a weaker dollar. He thinks the dollar has bigger problems than both the yen and the euro. I'd like your opinion.
Boy, I sure don't understand that. Because our dollar has been up since this crisis started in January. Most other currencies have been down. We've said this from the beginning. Our dollar already devalued 58% from 1985 to early 2008. During the boom, because we created more debt than any country in the world, what people don't understand, and this is really critical to get, when that debt deleverages and winds down and gets written off and restructured, it's only started to happen in 2008 at first before the government stopped it. That destroys dollars. That makes dollars more valuable. It gets your economy back into balance. So we already debased the dollar with the greatest debt bubble in history. As we eventually have to deal with this debt bubble, and eventually the governments can't keep banks from writing off this bad debt forever, it should improve the value of our dollar. So I see the opposite. I think the dollar is the safe haven. And if you look, the last time that we actually had a financial meltdown was in the second half of 2008 with Lehman Brothers and all that sort of stuff. The dollar went up, and everything else went down. Other currencies went down, stocks went down, gold and silver went down. We've been telling people that gold is not going to be the safe haven in what we see as a deflationary, debt deleveraging environment, what we call the winter season, and gold and silver have already plummeted. I think investors finally got when Japan stepped up and created an even more aggressive program than the U.S., I don't see how they can say Japan's better off than we are. They're stimulating at 2.5 times we are, debasing their currency on purpose. How could he say Japan's got, in a better position than the U.S.? Even when Japan finally did that and inflation fell anyway from 2% to 1%, people finally got, we're just not going to create inflation no matter how much money we print because it's not being lent and spent. That's the key. It's just going into bank reserves, and it's going into speculation by investors. Just like in housing, the money's got to go somewhere, so it goes in dividend-paying stocks. It goes into housing. People are desperately searching for yield, and the government's giving them no choice. So that doesn't create a growth economy. That just creates speculation, and speculation creates bubbles, and bubbles burst. I'm sorry. People say this bubble won't burst. I'm sorry. It's going to burst. Every bubble in history has burst, and everybody said at the top of the bubble, this bubble's different, and this one's not going to burst because of X, Y, Z. They're going to be wrong on this.
Harry, great explanation. Let me ask you, in your opinion, how does this this massive easing that Japan is engaging in, how does this end?
Well, there is a difference in Japan right now. Japan had their baby boom crash, in the 90s and in the last decade. They actually have an echo boom that isn't a positive spending cycle, and the government just wanted to jumpstart its economy and get consumers to wake up and start to spend because they've really been scared. So their stimulus is actually having more effect, but it won't forever, because stimulus only creates short-term impetus, and then people borrow a little more or refinance their homes or whatever, and then it takes more and more to create less and less. But I'm not too surprised that the Japanese stimulus is having more short-term effect than in Europe and the United States. Europe is just not working at all because their economy is so dead. And the U.S. is taking us $2 trillion in stimulus, half in fiscal, half in monetary, to get 2% growth a year. That's not a good deal. You put up 13% of your GDP in stimulus and you get 2% out the other side in growth. In fact, that's a really bad deal. But in Japan, they are getting higher spending, and their stock market has had a big run, even though it's set back. So it'll probably work for a little while. But stimulus never works long term, and it just creates imbalances and bubbles that have to burst, and it still hasn't lifted real estate prices in Japan.
Harry, you mentioned Europe, and if you look at what's going on in Europe, I read this week that Spain now has a higher unemployment rate than Greece. Much of Europe is in what could be described, I believe, as a deflationary depression. Yep. We have maybe approaching the 7th consecutive quarter of economic contraction. How much longer does this take place in Europe? And the second part of that question would be, is Europe a preview of what's to come in the United States and other places around the world when the easing does stop?
Yeah, Dennis, we call it the demographic cliff. Japan was first in the 90s. U.S. came next in 2007. We predicted that peak a long time ago. That's when the baby boomers would peak. Here's the thing about Europe. They're already in deep trouble because of their debt, and they haven't even fallen off the cliff yet. Most European countries are in a plateau until about 2013 or 14, and then they fall off a steeper cliff. I mean, Spain has the best demographics in all of Europe because they had such a huge immigration wave to fuel their construction bubble. But it is that bubble in real estate, which is far greater than other countries there, that is causing them so much trouble. You got so much unemployment because of that. You've got bank loans keep getting worse. Home prices keep dropping. They're now down more than they were in the U.S. at the bottom of our downturn, and they're still falling. So we've always said Spain has got the biggest problems over there, but surprisingly, they got the best demographics. No, same thing. If they got this big a problem now in the rest of Europe, and they haven't really fallen off the cliff yet, they've just been kind of in a plateau, how bad is it going to be? So I think, yeah, Europe, Japan was the first to go through a deep downturn, but they've been stimulating forever. Europe is probably going to fall into the next deep downturn because their government's just not going to be able to stimulate enough to prevent it, because when their demographics get weak, they get really weak. So, yeah, Europe is definitely something to watch. And China's got the biggest bubble in the world. And you know, my current newsletter, we're looking at doing an article. You know, they want to move 250 million more people from rural to urban areas. What are they going to do after they build their own apartments and high-rises and they can't go back to their farms? And the whole world turns down. These people, you're going to have people sitting in high-rises, nothing to do, unbelievable civil unrest. China's just rolling the dice, building stuff for nobody. They've already overbuilt everything for 10 years. Now they're going to up the ante. This is getting crazy. At some point, this global bubble is going to burst, and I am most worried about Southern Europe and China triggering. I don't think the U.S. is going to trigger the next crash. We did that the first time around. It's going to be China and Europe. It's a question of who blows first.
So, Harry, let's talk about Federal Reserve policy. And if you take a look at when Ben Bernanke just mentioned that they may cut back a bit on easing, we saw a significant spike in U.S. government bond rates. To what extent can the Fed continue to prop up this economy, and give us your view on Fed policy to this point? Has it been helpful, or is this just simply kicking the can down the road and the consequences will be worse as a result of the Fed policy?
Well, it's both. I mean, there's people who say the stimulus did nothing. That is 100% wrong. We would have been in a Great Depression. We were falling into Great Depression in 2008. All the signs, you know, banks going under. It took trillions of dollars to turn that around. You know, it's kind of like, you know, defibrillator, somebody having a heart attack and just have to wake up the thing, you know, the system again. Well, but it is only kicking the can down the road. It just means you're going to have a worse crisis later. We started to deleverage debt in the consumer sectors and financial and banking systems, and the government just stopped it. And now government debt's gone higher than ever. Consumer debt is kind of flattened out, and so we didn't really go through the deleveraging like we did in the 1930s that would free up consumers and businesses from debt at the expense of banks, but that's the way it should be. So we're just going to have to go through that later. And then Japan's been kicking the can down the road forever, but Japan had the luxury of being able to do that when the rest of the world was booming. We don't have that luxury. I mean, again, if Southern Europe blows up or China's real estate bubble blows up, and either of these could happen any time, and I think we're likely to see one of those go off in the next 6 to 12 months, then the Fed's not going to be able to control this thing. They're not going to be able to keep it together when other countries are blowing up. The whole world went down just because we had 4 states in a subprime crisis, for crying out loud. So if Spain and Greece blow up and exit the euro or have a big banking crisis, we're going to feel it here. And markets are going to go down despite this. And the Fed's already showing signs. The fact that they're buying bonds even more aggressively and yet yields are going up instead of down already shows that the Fed has lost some control of the market, because people do know at some point the Fed's going to have to back out. And without this, interest rates would be 100 to 200 basis points higher. And that's not good for stock valuations. It's not good for the mortgage markets and housing.
Here you use the term economic winter, and we use that term frequently here as well. Give us your view as to when the economic winter season turns to spring, and how does that transition occur?
Well, unfortunately, it's a while. We said this back in 1989, with our demographic cycles and a longer-term cycle, we said, hey, the winter's going to be from about 2008 to about 2023. So we don't turn up until the baby boomers around the world, and there's a lot of places they won't, like Japan by then. They'll be back down again, the next generation. A lot of Europe will keep falling. But when baby boom generation in the United States and Northern Europe and other countries turn back up again, we'll generate global demand, and that'll cause emerging countries to turn back up. And we'll have another global boom from about 2024 into about 2036 or so. But, that's 10 years from now. And in between now and then, governments are going to have to stimulate more and more because the demographics only fall more, especially in Europe. So to me, they're fighting a tidal wave of demographics and debt that at some point they will not be able to counter with endless stimulus. So, I think by next year we're going to be in trouble.
So, Harry, what would you advise, last question here, what would you advise clients who are managing a nest egg or clients that are trying to navigate their retirement years? Maybe they're just entering retirement today. What kind of advice would you have for them?
Well, my biggest thing is you have to think like a long-term trader. We're not telling people to be day traders, for crying out loud, but we've had these bubbles. They keep bursting. Every time stocks get bubbly again, and they're bubbly now, Later this year, start pairing your risk, getting into safer, shorter-term stuff, wait for the next meltdown, and then reinvest. So every 5 or 6 years, you got to get more defensive, and when there's a crash for a year or two or whatever, then get back in, because this is not a matter of markets just being down. They were up and down like a roller coaster in the 30s and the 70s when we're in this sort of seasonal transition. So protect your capital first. There's ways you can do that with insurance products and things. And most important for people who are thinking, real estate. No, get out of real estate this year. Use this strength in the market for this year to sell any real estate you don't need, like vacation homes or office properties that aren't strategic to your business. Do that to generate more cash, because our thing in general, cash and cash flow are king in the winter season. Everything falls. There is no diversification that works well. Everything falls, and the people who have cash and cash flow and don't need to rely on credit can step in and buy the world 20, 30, 40 cents on the dollar. Doesn't get better than that. That's how Joseph Kennedy made his fortune in a couple of years.
Terrific. Harry, give your website one more time for someone that's just joining us.
www.harrydent.com. You can get a free copy of our email copy of our Survive and Prosper. It's a daily newsletter. It's really good content.
Harry, thanks so much for joining us. Hope you'll come back again.
Okay. Thank you, Dennis.
We will return after these words. Stay with us.